Hello, everybody, and welcome to the Tortoise community. Happy to have you join us. If you are new to the channel, welcome. And if you are not, thank you so much for the ongoing support. I love having you guys here. And today's video is going to be on Evolution AB. And I know many of you guys are shareholders in this company, certainly the ones that have been following the channel for a while. And so I will break down the latest developments and whether I think this is still a good investment going into 2026, which we already are in, okay, and whether or if I think the story has changed, okay. So bear with me for the next few minutes because I think this is going to be jam-packed with action. Before we do that, let me just point a few things out. Number one, don't forget that our live session is going to happen next week. So the 31st of January, for those of you guys who are subscribed to the channel and want to learn more about my process or want to touch base on any investments whatsoever, make sure that you are subscribed. So if I go here to the channel, you can see right here live, ask me anything, investing wealth in live, okay? On the 31st of January at 10 a.m. London time. Also, let's discuss our thought of the week. Well, no, because almost on a daily basis, whenever I put videos out, I discuss some of the posts that I also create on LinkedIn, and because I think they are very insightful for you guys, and so I'm going to read this out. These are short form posts, but I think they are very telling. So as you can see, your brain was designed to keep you alive in the jungle, not to trade the S&P 500. What the hell does that mean? It means the human brain is a marvelous organ, but it's a terrible portfolio manager. It wants to run when things get scary and feast when things look safe. I mean, I love what our marketeer Pallavi does with some of our posts. It's just awesome, but it really brings home what the most important message that we try to convey. In the stock market, that's a recipe for buying high and selling low. I studied psychology because I realized early on that 80% of investing is just not panicking. Accounting tells you the value, ladies and gentlemen, but temperament tells you the profit. The average investor return is 3.6% returns. So I hope you guys know that, and it's quite sad to actually look at these annualized returns from 2000 all the way to 2020. Well, actually, I don't want to convey the right message. So bear with me 1 second as I show you exactly what the real time frame is for these lackluster performance. Let me go here to our premium deck. And this is one thing that I always show to the people that want to work with me because I'm very research driven. And you can see right here that the average investor has achieved around 3.6% annualized returns from 2002 to 2021. And this was a research that was put out by JP Morgan. So if you want, by all means, look it up. And what does that tell you? It means that the stock market is a device to transfer wealth from the impatient to the patient, and we are tortoises, which means we believe that slow and steady wins the race. Okay, so let me move on right here. Let me close this, and you can see that, the like a tortoise approach is certain. Well, it has been about 30% annualized returns, but guys, if you are doing anything above 15%, which I think you can absolutely do if you follow our framework, you can definitely achieve that over the years. You will see that the difference is not a fast computer or a hot tip from a cousin. It's the ability to stay rational when the world feels like it's ending. Okay, since 1936, the S&P has survived world recessions and global panics. It's gone up, but the price you pay for those returns is not cash. It's volatility and stress and stomach aches. So by far, the most important organ in the stock market is the stomach, not the brain. And I'm quoting our great Peter Lynch right now. If you cannot control your emotions, you are just a wealth donor to the patient people. Start investing like a tortoise. Are you a set it and forget it investor, or does the red screen make your heart race? So as Charlie Munger, quoting Charlie Munger right now, he said that if you cannot stomach 50% drawdowns in your portfolio, then you deserve the mediocre returns that you will have. And I completely agree with Mr. Munger. Okay? So if you cannot stand the price of long-term outperformance, and that comes in the form of volatility, you have no business selecting individual investments for your own portfolio. And in that case, and if you happen to have a very long time investment horizon, then you should definitely buy a low-cost index fund, and and let time working to your advantage, right? Because you are allowing compounding to work its magic over the years, but you are not trading in and out, which is the mistake that the average investor makes, which is why they underperform. So answering to my mate Jack Deep right here, is the S&P not good for passive income, Edu? I will come back to him on this, but the answer is it is very good for passive income, Jack. Just bear in mind that the last 15 years have achieved, the last 15 years have generated around 15 to 17% returns, which is fantastic. However, my thesis is that the next 15 years are not going to be equally amazing. And sure enough, if we look at data put out by JP Morgan Chase, as I already showed here on the channel, you can see that JP Morgan predicts the returns for the next 5 years to be around zero. Why? Because we are trading at one of the highest valuation levels in history. Not only that, this still remains, as you can see, one of the highest concentrated markets in history, where the vast majority of returns, and by that I mean about 40% of those returns, have been generated by the Max 7. Okay, so the likes of Nvidia's, Amazon's, Netflix, and Apple, and Google, and so forth. And so watch out if you have a shorter term time horizon, right? Because the chances are that the next few years you will see muted returns. However, look guys, if you still have 20-30 years ahead of you, then I think chances are that over the very long term you will achieve the 8-9% returns that the S&P has generated over the last 70 years. And that should make you feel very happy, because you are not doing any work other than putting your money aside, right, in a very low cost passive index fund. And so yeah, it's far better than the returns you would get on a savings account. Okay, so and let's leave it at that. But yeah, so this is it. But now let's discuss, and by the way, going back to what I was saying right now about buying high quality when it's low and selling when it's high. I mean, just take a look at what Novo Nordisk has been doing. I mean, absolutely amazing. A few of our clients bought this thing around the blue line, as you can see. They literally timed the bottom, which is something that we were not predicting that to happen. We knew that we were just buying a high quality company when it was trading at a huge discount to its fundamentals, in our humble opinion. And so, even though I don't own healthcare in the portfolio, right, because this is the industry in which Novo operates, you can see that, for example, healthcare, and I've been discussing this as well at length here in the channel. You can see that the healthcare index price relative to the S&P 500 has achieved one of its lowest valuations relative to the index in history. You would have to go back to the 2000 tech bubble to see this level of outperformance. And right after 2000, you can see that investors invested in this space really made a ton of money. And sure enough, I think we are now at the outset of something very similar. Now, this chart is no longer updated. Okay, so healthcare has already improved from the lows that you are seeing right here, but I do think the overperformance of this index, or excuse me, of this sector is going to continue well in 2026. Okay, and sure enough, the main players in this space, like Novo Nordisk, are poised to capture a lot of that growth. Okay. So congratulations to all of you clients and partners who are watching the channel, because I know that you are making a ton of money. And so congratulations. Okay, guys, let's discuss the most important thing. for today, and that is Evolution AB, because we too want this company to turn around, and it's been trounced. And so if I go here to the chart, you can see that this thing continues to plummet substantially. This level in 2023 marked its all-time highs, and right now we are about 60%. So yeah, so this is a 60% drawdown. We are already underwater. So because we have our cost base is around 730, and right now this thing is at 590. So I mean, let's discuss everything that you need to know. As always, guys, I took the liberty to put everything in a document which I will certainly share with our community members. So if you are not in our free communities, by all means, let me know, and I can add you both to our Skool community group and also to our WhatsApp group, where I share a lot of insights. Okay, so Evolution AB, 11% pre-tax yield from a global monopoly, long-term investment thesis. I will explain exactly what I mean by that. Okay, so introduction. Guys, I think, I mean, the next few quarters are going to be very important for Evolution AB. And but anyway, I don't want to spoil you guys yet. I don't want to spoil my thesis yet. So I will discuss it as we go along this document. So Evolution AB is one of those rare situations long-term investors look for: a dominant market leader with monopoly-like economics. This was one of the reasons that attracted me to the stock, right? Guys, they have no competition. Seriously. Extraordinary profitability, about 50% net income margins, operating in a structurally growing industry. What do I mean by that? The online gambling space is expected to grow by about 20% over the next few years. So until 2030, that is substantial growth for, and because Evolution is the has, in my opinion, monopoly-like characteristics, it stands to capture a lot of that growth. So, yet trading at a distressed valuation due to short-term fixable issues, in my humble opinion. At roughly 10 times earnings, and in fact, I think they are lower right now. Let me have a look right here. Yeah, so look, the P is at about 9.83 times, but the forward P is at about 10 times. So, okay, let's carry on. All right. At roughly 10 times earnings, the market is pricing Evolution as if its best days are behind it. This video explores why those assumptions may be incorrect and why a 2x outcome is plausible without heroic assumptions. And this is what I live for. I love this stuff. I love buying high quality companies that are so depressed that all it takes is like a small catalyst, just a small catalyst to boom, double our money in a short period of time. And that's the goal, right? So the monopoly of online gambling, Evolution AB is not an online casino. It's the B2B infrastructure provider powering the global online gambling industry. Okay? Supplies live dealer tables, games, and software, licenses its content to major operators such as DraftKings, FanDuel, and BetMGM. What do I mean by that? I mean that many of you may think that they are a casino operator. No, incorrect. They supply the infrastructure, right, in the games that allow the casino operators to then share them with the clients. Okay, but they are not the casino operator, which means they don't deal directly with the end customer. Okay, cool. So they earn a commission on player winnings, not a one-time fee. Very cool. Market position, here we go. The monopoly-like characteristics, about 60% global market share in live dealer gaming, which is something they themselves started. So they are credited with starting the live casino, the live casino sector. And so they benefit as well from the first mover advantage, because many years in the space allow them to build many partnerships with many of these casino operators, which create stickiness, which is something that we love. effectively operates as a monopoly in a niche with high barriers to entry. Okay, switching costs are high once operators integrate Evolution's best spoke studios. And sure enough, not only is the technology very costly, right, for those casinos, for those casino operators to build them in house, but the thing is, Evolution games are exceptionally good and customers love them. Okay, and so it's actually a win-win because it's cheaper for these casino operators to actually get Evolution AB solutions. At the same time, this bodes very well for Evolution AB, of course, because they are able to get fees. Right. So economics, net income margins around 50%, asset light, high scalable model. What do I mean by that? It means that as they grow, right? So as the company grows, and sure enough, they are expanding internationally, they can spread their costs out over a larger user base, which means they gain as well operating leverage over time because the costs necessary for the company to grow actually shrink over time. So they achieve what we love, operating, that is operating leverage. Okay, they become more efficient over time. I love that. And if I show you guys this right here, bear with me 1 second. If we go here to our stock unlock platform, you can see exactly what that looks like. And for example, if I flip this to the, no, let's skip this in the trailing 12 months. And you can see, look at this. So operating margin, look at this margin expansion over time. This is leverage. Okay, what we are seeing right now is operating leverage happening. So the company, as the company scaled its business, it was able to actually expand its costs over a larger user base. A lot of those costs were fixed, which means that they gain operating leverage. Now, at one point, operating leverage needs to stabilize. Of course, it cannot go to 100%, right? The company will always have some costs, operating costs. That's completely normal. And that's what we are seeing right here. That said, if I flip this to the trailing 12-month screen, you can see that the operating income has come down the operating margin has come down because operating income has come down as well since December 2024. And this coincides with some of the headwinds that the company have been facing, which we will talk at length here. Okay, so for example, if I show you net margin, same story. Look at this expansion over time, and now as profitability has taken a hit as of recently, it's coming down, but it's still very healthy because we are at 52%, while the medium and average sit at about 43 to 45%. Okay, 43 to 45%. Okay, so tell me a company, look, a company with 50% profit margins. This is ridiculous, guys, and it goes to show how big a moat this company still has. They literally have no competition because the second largest player, called Playtech, has terrible fundamentals relative to Evolution AB, and they are so far behind, it's crazy. Okay, awesome. And you can see, for example, if I show you the operating income, you see it's come under pressure as well, which is why you saw operating margin under pressure as well. Okay, look at this, absolutely insane. Okay, absolutely insane. Okay, but we always know that the markets don't really care about what happened in the past. They are forward looking, and rightly so. And so the question is, do I think the headwinds are temporary, or do I think they are structural? So let's continue right here. Okay, Ernst, the economics, we discussed that. Cash generative with strong reinvestment optionality. We will talk more about that. This is exactly the type of business Warren Buffett would describe as having a durable moat. Okay, I surely think that is the case. Okay, so why the market thinks the thesis is broken, and here I explain part of the mispricing. Okay, Despite a 5-year revenue CAGR of 43%, which is insane, Evolution now trades at a valuation typically reserved for declining businesses. So what the heck went wrong in 2025? Revenue growth temporarily stalled. And by the way, this is not something that started in 25. This started around 2000, end of 2023, and right. So if I go here, you can see that this started exactly around. This started around, yeah, I mean, beginning of 2024, essentially, and so revenue growth temporarily stalled. Management intentionally reduced exposure to unregulated gray markets in Europe. Right. This was. Let me give you some context if you don't know about Evolution. And by the way, for those of you who also want the whole reports and insights into my investment research, guys, I created a PDF with everything you need to know about Evolution AB. And these are the questions that I always ask before investing in any company, any company. Do I understand the business model? Is management capable? Does the company have a sustainable competitive advantage? Is the company active in an attractive end market? Remember when I told you that the end market was expected to grow by about 20%? Boom. Look at that. Well, actually, it was about 11%. Look, online gambling market. The global online gambling market was valued at approximately 65 billion in 22 and is projected to grow at a CAGR of 11%, potentially surpassing 120 billion by 2030. Okay, and you can see that the live casino is the section that is poised to benefit the most relative to the other segments. Okay, and then I discuss everything: the main risks, the competitive advantage, and you can see. I want to show you guys something as well. Yes, this should be somewhere in here. Look at that. Okay. We will touch upon that as well. So these are the main customers. For example, DraftKings will show up around here as well. These are all the partnerships, all the customers that they've had over the years. And you can see that this is geographical breakdown, right? You can see that still and right now, as of this moment, so the majority of their sales, this is not quite updated yet because it's been a while since the last time I released this report. But as of today, the majority of their revenues come from Asia. They still come from Europe. So Europe and Asia represent by far the largest portion of their sales. In both of these markets have been under pressure, as we will discuss as well. But what I wanted to talk about is the unregulated part of the unregulated market. I'm not sure if that will appear right here. Hold on, bear with me 1 second. There is just so much value right here, guys. It's crazy. Is the company a great capital allocator? This is from Stock and Lock. There I took a screenshot. How profitable is the company? I discuss all of this at length. And no, it's not here. But what I want to say is that for many years, they were generating the majority of their revenues from unregulated, also called gray markets, in not just in Europe but also in Asia. What the heck does that mean? It means that they are not licensed. Okay, so regulations are not clear there. And sure enough, for a while that bode well for the company. But now, as many of these companies, many of these regions are moving, right, are pushing towards regulation, that has been denting revenues as well. But this is also important for you guys to understand that Evolution is also intentionally now moving into regulated markets. And this is something that I think will be accretive over the long term, right? Because we want sustainable long-term growth. And as long as revenue comes from unregulated markets, and at one point that represented more than 50% of their revenues, that will create a lot of uncertainty, right? So the more they shift towards regulations, the better, not least because fund managers will also feel more comfortable plowing funds into plowing capital into this company, right? Because they want transparency, they want to see regulation. Okay, all right, so look, increased spending to combat cyber piracy in Asia, where illegal operators were stealing live dealer feeds. This is very unfortunate, and it's been part of the bearish thesis against Evolution AB. Not only are they facing issues in Europe with the will the self-imposed ring fencing measures, right? In other words, they did that on purpose to create thinking over the long term. So this is something that can hurt them over the short term, but I think will bode well over the long term. And I'm a long-term shareholder, so I see this as a positive. What I don't really like is that cybercrime in Asia is still prevalent. And despite many quarters of fighting it off, they are still many of these issues are still pending, and so over the next few quarters, I want to see a resolution to this conflict. I want to see that the things in Asia are improving, not stagnating or even deteriorating. Okay, so these actions hurt near-term growth, but were defensive and strategic. That is certainly the case in Europe. Oh, and by the way, and also in they mentioned in the last quarter that some of the measures, right, some of the cybersecurity measures they implemented actually affected complete legitimate users, unfortunately, which cost them some revenue, and that's why they saw some impact in the last quarter as well. So yes, it was unfortunate, but we will see how the next quarters, what the next quarters have in store for us. Not structural problems with demand or the business model. What do I mean by that? I mean that customers are still eager to watch their games, right? So because if you see, you can see that they are using their games now more than ever. And sure enough, if that wasn't the case, why would they expand internationally? They stressed that out over the conference call that they see a lot of demand for the product, and so they are expanding. The market extrapolated short-term pain into a long-term narrative, a classic setup for mispricing. Now, at the beginning, as I showed you, I discuss and why a 2x outcome is plausible without heroic assumptions. It's based on current valuation levels. This is not a complex valuation story, okay? I want you guys to understand something. The share price right now is at 67.5. Is it not? Yes, I did this yesterday, so it's actually 65 right now. So let's go back. So the market cap stands at about 13.06 billion. Okay, net income. This is how much they produce in dollars. The valuation is about 10 times PE, right? So the conservative intrinsic value, if we assume a modest P of 20, that alone will double our money because the forward P is about 10, the current P is about 9, and so for the multiple to go higher, in fact, we can double our money simply if if the P just expanded to 20. And what would that require? Well, it will require that some of growth, for example, can they turn the growth around in Asia? So if we see if the next quarter shows us some improvements, right, both in Asia and Europe, which are the major markets, but especially in Europe, because in the last quarter we already saw some positive developments coming out of Europe. But so if we see some growth in Asia, I think what will happen is that analysts will have to adjust their growth expectations. That will for sure make the intrinsic value in their calculations go higher, and the P will immediately expand. Okay, and so not much needs to go our way for us to double our money in this company. Okay, that's the main thesis right here. So a modest 20 times P is still below the current S&P 500 multiple at 30, which is absolutely mental. So this would imply a market cap of 29 billion for sure, right? The market cap is 13.4, a double of that is around 29 billion, and that would equate to what? $143 per share, okay? So that represents a 100% upside driven purely by mean reversion. And by the way, guys, even a modest 20 times PE is still below this company's long-term average. So if I show you here our where the magic happens, our template, you can see that for evolution AB, you can see that the historical PE is around 34. And so 20 is still well above the long-term average. Okay. So, I mean, it's not like, oh my God, they never achieved that. No, they are still a growth story. All right. So, this is why I still think there is so much growth potential going forward. Okay. All right. What else did I want to show you? Look at this, guys. Okay, so if you are watching this channel for the first time, we always, myself and my clients, we always use this sheet for our calculations because it just will. I like to see everything. I pull all the findings from different sources, and I like to see the numbers combined together so I can make better sense of the data. And so on the left hand side, you can see the most important elements. Excuse me, the most important elements of both of the balance sheet, the income statement, and the cash flow statement. And on the right hand side, you can see the most important ratios. Look, the valuation ratios, profitability and value creation metrics, margins right here, capital intensity, solvency metrics, and so on and forth. And what you can see right here, I mean, look at the P is absolutely insane, right? Yeah, absolutely insane. And for sure, if I show you this right here, you can see that the current shareholder yield is 7.79% and the earnings yield sits at about 10.11%. Excuse me, 10.18%. What the hell does that mean? It means that if you bought the whole company today, this is how much the company could return to you in pure earnings on a daily basis without assuming any growth going forward. Okay, and with free cash flow, you could bank 11% on a yearly basis. So I mean, absolutely insane. And let's continue. You can see that the margins are fantastic. And what's more, look at the capital intensity. So, for example, capex, the capital expenditures relative to revenues sit at about 2.70%. Ideally, I want to see this under 5%, so it matches our criteria. Why? It means the company doesn't need to spend a lot of money in order to achieve great returns on, in order to grow a lot and to achieve greater returns on invested capital. And you can see that this capex as relative to operational cash flow currently sits at 4.70%, well below our preferred thresholds of 15%. So that is incredible. Okay. In addition, look at the debt to equity, look at the debt to free cash flow, and look at the debt to earnings. So what happens right here is that this company is not only very capital light, but they have a pristine balance sheet, which means in this case that they also have a net cash position. Okay, that is so cool. Something that I really like. And you can see right here the returns, the financial efficiency. Look at all these returns. Look at the return on invested capital, right? Well above our preferred threshold of 15%. You know, look at the weighted average cost of capital at around 10%. What does that mean? If you do 36.19 minus 10, you get, this means, so Royce minus WACC equal is Royce minus WACC is called, we call it economic spread. And what it means is that the company generates returns far in excess of its cost. So the returns the company generates right now are well in excess of the cost of funding, which is a lot of, which means they create a lot of shareholder value, and that is something what we want. So the higher the discrepancy between Royce and WACC, the better, right? The more they make, so the better the how can I say? It means that they generate more returns, right, relative to the cost of funding those investments, which is something that we really like. That's good. It's called economic spread, if you didn't know that already. Okay. What else did I wanted to say? We discussed margins. Look at that. Debt to EBITDA. Ideally, I want to see, for example, debt to free cash flow under 3, which means it takes less than 3 years for the company to pay down all of its debt. Look at that. I mean, this they have no debt, practically no debt. In fact, I think they only have long-term leases. And leases are not bank loans, so they don't have to pay interest payments on the debt. In fact, they do have some interest expense right here, and it's gone up. But what I can show you right here, look at that. It's the long-term debt that I'm after. Let me show you right here. What am I doing? Balance sheet, excuse me. Okay, so long-term leases. Here we go. They have long-term leases, and you can see that they don't have long-term liabilities on the balance sheet. Okay, and if so, look, they have leases. Look, current portion of long-term leases. They have leases, both short-term leases, okay, and then they have long-term leases as well. Both of which, according to both of which by accounting standards can represent that total debt that you can see right here. Okay, so yeah, it's what it is. But also, I wanted to show you something. Look at the cash conversion ratio. Okay, I discussed that the cash. So I like to invest in companies with cash conversion ratios above 100%. What the heck does that mean? The cash conversion ratio, you do the operating cash flow divided by net income. It shows you how well the company converts profits into actual cash. Okay, and so if this ratio is above 100, it means that we have high quality earnings, because the majority of those earnings are converted into cash, right? It's a sign of efficiency, as you can see right here. It measures how efficiently a business turns profits into actual cash. Okay, and this is what we want. All right, what else did I want to say? I think we already touched upon the most important things. So let's continue with our PDF right here. Okay, that's 100% upside, purely by mean reversion. And then the valuation floor. And what the heck do I mean by earnings yield at 10 times PE? Okay, guys, I'm going to show you this right here. Okay, so look, yeah. So the earnings yield at 10 times P is about 10%, as we already discussed. The dividend yield is about 5%, share buybacks 4%. So this creates a compelling downside buffer while waiting for growth to reaccelerate. In fact, the total shareholder yield, right, as I showed you already, this is the sum of the buyback yield with the dividend yield. And this is, I mean, guys, you are essentially getting paid just to wait for the company to turn around, which is very, very good. Okay, I love that. Okay, so now key catalysts for the re-rating. Number one, Brazil regulation 2025. Brazil is legalizing and regulating online gambling. Evolution is already licensed. Operating at a dedicated São Paulo studio opens a massive new regulated market almost overnight. I love that. Galax Gaming acquisition, which they announced recently, and this is meant to end around mid 2026, grants Evolution intellectual property for table game side bets used in physical casinos. Why is this such a big deal? Guys, is because this will allow Evolution to have, by acquiring this company, the synergies that can occur are just staggering, because it takes a lot of time to get those licenses. And so what do they think? Why don't acquire a larger player in this market already? And sure enough, boom. This acquisition secures 131 licenses across 28 US states. Okay, brings Evolution into omni-channel gaming, online plus land-based. US expansion, continued rollout of bespoke studios for US operators, increases switching costs, deepens Evolution's North American moat. RNG/slots acceleration. Slots now grow faster than live dealer. That happened in the recent quarter, and I think it had never happened in the company's story. I still think this market is going to be the best one as well. Okay, the reason this accelerated faster is because the other one is under pressure because of all the headwinds that we already discussed. But this is driven by internal studios like Sneaky Slots, pipeline of 112, 110 plus new games. They are continuously releasing new games, which is fantastic. So, as we mentioned, high margin, scalable growth engine. What about the bear case? What exactly can go wrong with our thesis? Number one, of course, the big elephant in the room, regulatory risk, gray markets. About 55 to 60% of revenue still comes from unregulated jurisdictions. Incorrect. This needs to be updated. I think the name as of recent quarter has already come down, and it's actually hovering around 50% as I record this video. Sudden crackdowns could impact revenue quickly. Okay, this is important. Cyber piracy in Asia, illegal operators stealing live feeds. Countermeasures are costly and can throttle growth. Failure to win this technical arms race could impact Asian revenue. And we see, for example, other Asian markets like India already moving towards regulation, which can also affect revenues over the short to medium term. Okay, sovereign and political risk always important, right? Because they operate across different geographies. So, for example, Philippines anti-pogo act banning offshore gaming highlights geopolitical risk inherent in the sector. This is not a risk-free investment, but the valuation already reflects a lot of bad news. In fact, I would say the valuation already reflects all of the bad news. Guru and insider activity. Let's discuss important things, guys, as well. If I show you this right here, if I go to my insider tab, you can see that the management was busy buying shares with their own money in the last 12 months, right? So this was June 2025. Look at this. The CEO, right, was buying shares and overfeast. I love that. What's more, look at the insider ownership, over 20%. So we are talking about a lot of skin in the game here. And if I change this to our ownership tab, you can see that Dark Kenneth still owns about 70%, 17% of the company. Okay, I mean, talk about high skin, talk about high skin in the game. This is what we want. We want to see that our incentives are aligned, preferably. Okay, moving on. Look at that. Here we go. Known for distressed and deep value investments, signals strong conviction at current prices. Insider buying, as we already discussed, the CEO was buying millions of stock, millions of dollars of stock. Buys made at prices well above today's share price. Share buybacks, Evolution itself is a buyer, 4% of outstanding shares repurchased in the last 9 months. If I go here to our financial statements and I go here to our income statement, look at that. Look at the diluted shares outstanding. So if I go here to 2021, you can see that the share count has been reduced by about 9%, which coincided with the company coming down as well, which I like a lot, right? And this is exactly what I want to see now that the stock is trading at all-time low valuation levels. Okay, so Buffett lens, the pre-tax earnings yield. I want to talk to you guys about this cool stuff that I love. So, guys, if you don't know this already, Buffett always values businesses using the pre-tax earnings. And if you don't know where you can get that, you can come here to the financial statements. You go to the income. In fact, let me show you this right here. You go to the financial statements. Okay, you come here to the trailing 12 months and you can see the pre-tax income is right here around 1,390,000,000. Now, remember, this is in euros, okay? And the price is in dollars. Make sure the currencies are consistent. And so what you can do is you can take this number and you convert euros to dollars, okay? And then what you do, you divide the pre-tax income by the number of outstanding shares, and that gives you the pre-tax income per share. And then what you do is you take the pre-tax incomes, you take the pre-tax income per share and you divide that by Evolution current stock price, and what you will have ladies and gentlemen, is a pre-tax earnings yield of almost 12%. That is staggering. Okay, this implies that at today's price, investors are earning an 11.6% pre-tax return on current earnings. Okay, and then what you can do is do the math. So, for example, uh, you can see right here that the current earnings per share is about 6.49. And let's assume that I think the company can grow its earnings at about 10%, which is exactly what I'm projecting, right? 10% over the next 10 years. All right. So we grow 7.49 at our projected 10% growth rate over 10 years. And what that leads is, here we go. You get exactly, excuse me. So we take the pre-tax earnings, right? So this is the number that we calculated above, right? So let me do that. We take this, we go here to our calculator, okay? Calculate future value. We do this here. We assuming a projected 10% CAGR over the next 10 years. Let's do 10 years, and you can see that this translates into 19.58. And what you guys want to know right now is your cost basis right here, right? Your yield on cost. Excuse me. Your yield on cost is what you want to find out. And sure, if I show you this right here, you can see, here we go, we have our 19.6 right here, pre-tax earnings per share, right? And then on a 65 dollar, this is not pounds, this is dollars. On a $65 entry price, that implies a 30% pre-tax yield on costs. Okay, that is staggering. And this only assumes a 10% growth rate, and I do believe that the company still has a long runway for growth, and I think they can perfectly well exceed these 10% growth rates going forward. But I'm being very conservative, guys, as I normally am. And sure enough, I love the pre-tax earnings yield that I'm getting right now. In fact, one of the things that I discussed as well with some, I don't know why my camera is not showing up, which is quite unfortunate. Not that my face is nice, then you guys should see it. But anyway, okay, yeah, I just don't like this stuff. But anyway, one of the things that I like to do as well is I created a resume, a summary of the most important books that I've read so far. And if I go here, investing book summary, I have that on my drive. And for example, one of these books that I did a summary on was on Peter Lynch, One Up on Wall Street. But there are more. So in one of these books was none other than Warren Buffett and the interpretation of financial statements. And you can see in that book that Buffett talks about the pre-tax yield and the yield on cost over time, and you can see the kind of investments that he did in the past. For example, Coca-Cola in Washington Post, and you can see that the pre-tax yield that he was getting when he bought these companies was at least at 10%. Okay, which in of itself already has a significant margin of safety built in. So, for example, let me show you, because I really want you guys to see part of my analysis process. Let's pre-tax. Come on. Yeah, boom. Write this. Look, this book. These are the summary of all the chapters of the book, Warren Buffett in the interpretation of financial statements, and you can see. Let me just zoom in on this. You can see that one of the chapters, guys, is short-term debt can kill you. Where is this? Retained earnings. This is treasury stock. I think I may have already passed it. Right here, chapter 53. Warren Buffett's revolutionary idea of the equity bond and how it has made him super rich. And you can see, look at that, For example, Buffett began buying shares in Coca-Cola in the late 80s at an average price of $6.50 per share against pre-tax earnings. Let's not so this, yes, against pre-tax earnings of 0.70 per share, which means that is so which means that which equates to a pre-tax rate of return of around 10.7%, right? So you just do the $0.70 divided by the price that he paid, which is exactly what we did right here. So we know that our pre-tax earnings per share is 7.4555. We divide 7.55 by 65, and we get our pre-tax earnings yield of about 11.6%. You can see that the pre-tax yield that we are getting right now from Evolution AB is even greater than the 10.7% he got from Coca-Cola, right? And then what did he do? He assumed 15% growth for the next 10 years. And sure enough, in 2007, the pre-tax earnings had increased to $3.96 per share, right? And that represents a pre-tax yield of 60% because 3.96 divided by $6.50 per share means exactly a pre-tax yield of 60%, which is staggering, okay? And sure, if the company goes on to increase its pre-tax earnings per share at a compounded annual growth rate of 10% over the next 10 years, in 10 years, we are going to get a 30% pre-tax yield on costs, okay? So I just wanted to make this thing very clear for all of you guys. What is our main takeaway then? Evolution AB looks less like a broken business and more like a dominant monopoly, temporarily misunderstood, trading at a valuation that assumes permanent trouble. If growth merely normalizes and valuation mean reverts, the upside is exponential, in my opinion. The key question for long-term investors and for all of you watching this video, is this a rare monopoly on sale or a value trap hiding behind great margins? I've already made up my mind. I believe it is the latter. But of course, always do your own due diligence, ladies and gentlemen. Don't take my word for it. Everything that I do here is for educational purposes, certainly not financial advice. That said, I put my money where my mouth is, and you guys know that I'm very happy to be invested in the company. Okay, so guys, this was a very long and educational video. Hopefully, you share the same opinion on it. If you liked it, just smash the like button. It takes a while to put all of this together. And thank you so much for everything that you guys have done over the past few months. Whenever you guys share your feedback, it's also amazing. Thank you so much, and let's continue to grow ahead. Let's smash it in. See you next week, 31st of January in our live call. Have a great rest of your weekend.